Hi everyone, thank you very much for joining us for our first Spotlight On for 2015. It's good to have an old friend back. John Carter is on with us today. John, of course, is still involved in our Stocks and ETFs Update Tuesday market commentary webcast, but he hasn't been on the Spotlight On series in quite a while, so we invited him to join us, and I'm glad he was able to accept and be with us today. I want to make a few announcements before I turn it over to John and he gets into his topic of high probability trading setups. One of the first things I want to mention is we do have another Spotlight On coming up later this month, and it will be another good friend of ours. Raghi Horner will be on in 2 weeks. You can use that link to read the description of her topic and register. And if you know Raghi, you don't really need a description of the topic because she's always a lot of fun to listen to and get her perspectives on the market and have a couple of laughs with her as well. She's a wonderful presenter and an interesting technician. That's coming up, and we do have some more coming up in February. They're not on the calendar yet. John Clayberg is going to join us in February, and we've got some more coming up as we get into the spring as well. But Raghi's is posted there if you'd like to register for that. A couple of other announcements. This presentation will be archived in our with our other Spotlight On presentations. You can get that in one of many different ways now that we make our videos available. We are a regular video machine. You can get that in our TradeStation app, and you can get that app in the trading app store and plug that in, and it'll install right into your TradeStation platform. A lot of people are enjoying using that. If you don't want to use the app, you can get it on the page with the Spotlight On archives, and if you don't want to do that, you can get it on our YouTube channel. So I've given you the links for all of those. All of those videos, they're the same videos either way you access them. We've just tried to make them convenient for those of you who are on YouTube. Of course, we do have a channel. And if you prefer using the TradeStation app, which has been very well received, you can go ahead and install that gratis, and you can watch the videos right in your TradeStation platform. But they are the same videos, so make it easy for yourself, and that's what we're trying to make it easy for you to access that information. A couple other things. One other commercial announcement. John does have some indicators in our trading app store. By the way, it's also in the trading app store that you'd get that TradeStation app. If you'd like to take a look at John's page, you can use that link, and you'll see what he has available there. And of course, you can visit his website as well for more information about his books, videos, his trading room, and other services. But you can also take a look in the trading app store at some of the items that John has available in there. Now, as we get into this presentation, I might throw some more links at you as we get going, but I do want to make sure I cover my obligations. Of course, John is independent of TradeStation, so his views on trading in the markets and risk management are his own. And in particular, I want to mention that John is going to talk about approaches to identifying trading signals, mean reversion, trend following, when volatility collapses and then expands. I think his views on generating signals and finding opportunities are really valuable. Now, he often puts it in the context of options. So if you're an options trader, you might want to follow up with an options kind of position. If you're not an options trader, you may still, there's value here in understanding the signals, and you may follow up on them directly in a stock or ETF or in the futures markets. Just remember, of course, that options, if you do follow up on options, options do have particular risks. You should be aware of those risks, and of course your account has to be pre-approved for options trading. Just please keep those in mind. You can access the characteristics and risks of standardized options. If you've never seen it, you can click right on this slide, and it'll grab the PDF for you. I also have it available in the documents area at the lower right, and as soon as I find it, I'll push that into the, here you go. I'll push that into the chat along with the important disclosures. So please keep that in mind in particular, because John does like to put the signals he's going to generate often in the context of an options trade. You can manage the trade as you see fit, but just remember that in relation to options, please. All right, I'm ready to turn this over to you, John. I'll mute my microphone, and you have the floor. Thank you.
Okay, fantastic. Thank you, Stan, as always, and thank you, TradeStation, for having me. The first question I just want to make sure before I get going here is that I'm assuming that you can see the slide that says options trading, simpleroptions.com, and I've got a little laser dot there. I'm just assuming you can see that. Okay, cool. That's always half the battle. You get started on our presentation, it's kind of like, what are you talking about? Well, okay, so that makes sense. Okay, so I'm going to talk about options trading. And I've always been fascinated. I mean, my journey with trading, excuse me, I've had a retail trading journey, and I've started off learning the hard way, and then just kind of, as I was fortunate enough to end up spending some time on trading desks and working with market makers and other people along the way, I just learned a lot. And the first thing I learned is that this is an emotional cycle that every trader goes through, and it's just important to keep this in mind. And because we're neutral, we're completely neutral when we're flat, but once we start putting on positions, things can get a little nuts. And when we first put on a trade, we're optimistic, and then we get excited and we're thrilled, and we talk about how smart we are, and when we hit that euphoria, I call that the high five area. It's like, all right, and then it starts coming down. It's like, oh my gosh, all right, darn it, this is coming down. I guess I'll get out when it comes back up. And then there's denial. I mean, at this point, I should probably be out of it. And then it's fear. Gosh, what if this turns into a loss? And now there's desperation and panic, hoping that it's going to come back. And then finally there's capitulation and despondence, like, why am I doing this? And it's important to realize this, because at the moment of capitulation and despondence, that actually is typically the best time to get into a trade. So what happens is people go through a cycle where they're getting in at the highs and getting out at the lows, or vice versa if they're shorting. And it's just kind of keeping that in mind, that the market actually tricks you into that cycle. And just understand that, if you see something you're starting to get excited about, you're going to get it. Just remember, where are you on this cycle? Okay, so it's important to kind of keep that in mind. So the continuing problem in trading, and a lot of times people think it's, yeah, okay, you got to learn more and more indicators, and you really don't. It's really just having a professional mindset on the next trade. And all having a professional mindset is just thinking in terms of, wow, anything can happen. I'm going to trade. I'm going to act like I'm a professional, meaning I'm going to position size correctly. I'm going to, have a couple of basic indicators on there, and I'm just going to follow a plan, okay? Because if you don't do that, you forget and you get caught up into that emotional roller coaster that I talked about. And I love this little post here. It's like, have a professional mindset on every trade. You must. So my Yoda impersonation for my kids. So just kind of keep that in mind as as we're going through this as well. So what I want to talk about here is I'm going to talk about the 3 types of technical analysis. And yes, I know there's thousands of indicators out there, but there's only 3 types of technical analysis. And now I'm going to try to tie that into options trading. And if you haven't traded options, don't worry, because of course you can just trade the stock or the ETF or the futures contract or whatever it is that you trade. But I look at it from the perspective of, if you want to do that, that's fine. But if you also wanted to trade an option on it, I'll also kind of throw in how I do that and what I would look for and all that kind of stuff. So the bottom line is, to navigate a market, you must first understand how to read it. Okay, and I was fortunate enough in the, 2005, 6, 7, 8, and 9 is in the good old days when the CME and the CBOT were private. They would fly me out there to Asia all the time. And I remember the first time I ended up in Taipei, being in an own market, and I just didn't know how it worked. So I had to understand how that market worked so I could read it and know where to go for different things that I wanted to get. And it's the same thing in the stock market as well. So before you pull the trigger on your next trade, realize that trying to anticipate price is the #1 death knell of all beginning traders. Now I know that sounds crazy, because if you wouldn't buy a stock if you weren't anticipating that it was going to go higher, right? But the problem is if you anticipate that it's going higher, a lot of times you're not in the right frame of mind to deal with it if it doesn't work out the way you thought. Okay, so instead of anticipating, just participate. Don't waste time for looking at all the reasons why something is happening. Okay, don't anticipate, just participate. The history of the markets is littered with the bodies of those who were convinced of where price was headed next. How many people have been buying oil all the way down? That kind of thing. Nobody knows exactly where it's going to go. All you can do is participate and know your risk. And I love this quote: markets can remain irrational a lot longer than a trader can remain solvent. And that is true. Now, there are 3 types of technical analysis, and there are only 2 types of trading. There's counter trend trading that capitalizes on the market's need to revise to the mean. Okay, and I'll talk more about that. And then there's trend following models that take advantage of those times when the markets undergo what I call a fat tail event. A fat tail event is when a market goes from being choppy to suddenly everyone is pouring into a move. In general, stocks are chopping back and forth 80% of the time and strongly trending only 20% of the time, all right? And a strong trend can, at some point, turn into a fat tail. So what is that? So here's a stock that I like to trade. It's BITA, BITA. This is an Investor's Business Daily Top 50 stock. And you can see here that a stock or a market that participants feel is fairly priced will stick close to its average price over the past 21 days. So all that is a 21 period moving average. And when you have a choppy market, if you get too far away from that moving average, i.e. the mean, the market reverts back to the mean. Okay, and if you get too far away to the downside, it's going to revert back. Okay, and this process goes on and on and on. And I always say be careful when a stock is too extended because it needs to revert back to the mean, right? And so you can see what happens here, but then suddenly something happens where this thing just takes off and doesn't look back. That is what is called a fat tail event. Okay, so here is reversion to the mean. And this you could just say, hey, this is a nice trend. It's holding that 21 EMA, but this is a fat tail event, all right? So it's just understanding that. So the three types of technical analysis, there's oscillators, oscillator indicators, trend following indicators, and volatility indicators. And that's it. There's no magic involved. It's just math. But most traders don't realize which of these indicators is actually the most important. So what I want to do is let's dive in and take a look. So first let's talk about oscillators. So oscillators are overbought and oversold indicators for reversion to the mean type trades, okay? Now, what this means is that you do not use oscillators in a trending market. You don't need to. They're worthless in a trending market. Overbought can stay overbought a long time in an uptrending market. Oversold can stay oversold for a long time in a downtrending market. When you have a market that's in a reversion to the mean type of environment, the oscillators are priceless. So I like to do this with daily charts, and I'll talk about how I do this with stock options. My favorite oscillator is a 9-period RSI, which is the relative strength index, with overbought labeled at 65 and oversold at 35. I also have an average true range set to 21, and then I add 3 Keltner channels with the following settings. 21 and 1 as an average true range, 21 and 2, that 2 is the average true range, and 21 and 3, all right? Now, I've always been a fan of the 14 and the 21 period average true range as a level to keep in mind when I'm placing stops and when I'm looking at first targets. Now, these days, I typically just use the 21 as it provides a little more wiggle room when initiating spreads if I happen to be doing options. Note that a squeeze can easily push a stock beyond the 1 average true range period. All right, now these are great levels in which to take some chips off the table and trail up stops. And it is also good to look at these charts when you are tempted to chase, as it makes it very clear that you should have already been in this trade and makes you really question your entry points. All right, and we're going to look at a stock here in a second. All right, a chart. The average true range shows the value of the average daily range of the stock price over the past X number of periods. It is a useful value for placing stops because it allows you to place your stop outside the noise, and it also allows you to place realistic targets. If you are in a shorter term long trade on CMG and the average true range is $9 and you wake up to a $9 move in your favor, then take some profits. It just did its average move, okay? i.e. what else are you waiting for? And that happens a lot where you get this great move and people just keep thinking it's going to keep going higher. But if it's already moved a factor of its average true range, it's done. Okay? I call that feeding the ducks. And I love this picture, and put this in, it says, and then I said, no, it's not too late to get into CMG. And what happens and stuff like that is that, when something's rallying and people that are already in it, they want to sell it to someone else. So of course, they want you to buy it. And that way it can continue going up and they can sell into strength. So the average true range, what I like to do is see how many average true ranges a stock is trading away from its mean price. Remember, the mean is the 21 period moving average on a daily chart. It's not critical if it's the SMA or the EMA. I actually, normally for moving averages, I'll use the EMA, but for the purposes of average true range, I'll use the SMA. And again, it's not a make or break kind of a thing. Once we move one ATR away from the 21 period moving average, I want to take partial profits and move up stops. So this becomes a great tool for managing the trade. If we move 2 ATR away from the 21 period moving average, I will generally be out of all my position, and then I'll start looking for a reversion to the mean. Okay, now all of this stuff is already on your platform. You just have to tweak it a little bit, and I'll show you how to do that. So within TradeStation, you're going to add the average true range and change the input to 21. And then you're going to add 3 Keltner channels, and you're going to set it to 21 and 1, 21 and 2, and 21 and 3. Now, this is what your chart's going to look like. Now, you can see here that the lines up here, they're a little faded, but you're going to see that the white line is the mean. And then the red lines, which are at the very bottom, that shows you the 3 ATR level. The purple line shows you the 2 ATR level, and the green line shows you the 1 ATR level. And you're going to have these 1, 2, and 3 ATR levels both below that 21 period moving average and above. Okay? So now when you get a situation like this, when the RSI is overbought and we're into the 2 and 3 ATR levels, that is a perfect time to start looking for what? A reversion to the mean. Conversely, if we're down here at 2 or 3 ATRs and we're oversold, we're going to look for what? A reversion to the mean. Okay? From an options trading perspective, now this happens to be TLT. If it's this far, you could just short TLT, that's fine, and cover it on a move back. Down here, you could buy TLT and sell it when it gets back there. That's classic reversion to the mean. If you're familiar with options trading, then up here you could buy puts. Down here you could buy calls. Or if you're familiar with premium selling techniques, as we get up here, you could sell a call spread, okay, where you sell like an at the money or slightly out of the money call, and then buy the one that's up near there, so you have a limited risk spread. And then down here, you could sell an at the money or slightly out of the money, for example, 1 standard deviation put credit spread, and that becomes a high probability, low risk trade because you're doing it as a spread, which has limited risk. Okay, so how to do this. So I love this chart. There's so many things that you can do with it. And the first rule, of course, is not to fight the squeeze. Now that's an indicator that I'll show you here in a little bit. If there is a daily or weekly squeeze that is fired long, then don't fight that trend. And this means take profits at the average true range levels and reload on pullbacks to the mean. Which again, I always say this, the 21 period moving average, because sometimes people will say, what do you mean by the mean? It's like, well, that's that moving average. However, if there is not a daily squeeze or a weekly squeeze, then we can implement counter trend trades with the idea that they will move back to that moving average. Okay, in this case, you can either buy a long option or sell a spread, as we just talked about on the previous slide. All right, so what do we mean here? Here's Apple. Here we move 3 ATR or 2 ATRs away from the mean, and we're overbought, and there's no squeeze. Okay. Cool. Here I can sell a call credit spread, either an at-the-money call or a 1 standard deviation out-of-the-money call, or I could buy puts. Selling the spread, of course, if you're familiar with premium decay, that is a higher probability trade because it could trade sideways for a little while longer and you could still make money. Okay? And here's another situation where we come up a little too far away from the moving average, 2 ATR, overbought, bam. And now to the downside, we come down 2, 3 ATR away, we're oversold, bam, we retrace. This happens over and over and over again. Now with options, you can always sell further out. For example, if price is trading at the 2nd ATR level, then if you're familiar with options and you know 1 and 2 standard deviations, you could sell 1 standard deviation away, okay? I'm actually fine selling at the money options because you can get a 1-to-1 risk reward ratio, and you can of course sell 2 standard deviations away. And I'm a big fan of scaling in, okay? So if your full size on a trade is going to be 7 contracts, then I would look at, as it starts to rally, sell 1 at the money spread at the first daily ATR, and then sell an additional 2 at the money spreads if it gets to the 2nd ATR level, okay, if it gets there. Then finally, if it does get to that 3rd ATR level, which remember is an extreme move, then I'll sell 4. That gives me a really good average price, and I'm not kind of betting all my chips at the beginning. Now, I'm not a fan of scaling in if you exceed your full size. So the only way to scale in safely is to know what your full size is and your full risk on the trade, and then don't start with full size. If your full size is 7 and you start off with 7 contracts, you're done, okay? So I want to make that clear. And then the one thing with options that I'm a huge believer in is the idea of giving yourself the gift of time. If you're selling or buying an option that expires in 2 days, you're putting yourself at the mercy of the markets. However, if you sell or buy that's 30 or 60 days out, now you've got actually a lot of wiggle room, okay? One of the things I like to do is sell spreads on the SPX and the NDX and the RUT 60 days out and then buy them back 10 days out or even let them expire, all right? And it's also okay to sell them about 10 days out and buy them about 3 days out. But if you're going to do this, then you want to know which levels to sell these at, right? So what you can do here, if you're selling options on RUT 60 days out, this is how I would do it. At point number 1, we move up 1 ATR, and the price is at 11.52. So I can sell one 12.30, 12.40 call credit spread 60 days out. All right, and then we move up to the second ATR level, and at this point I'll sell 2, and we're at 11.65. I'll sell 2 of the 12.50, 12.60 call credit spreads that same month. And then at point number 3, we get up to 3 ATR, and here I can sell 4 of the 12.70, 12.80 call credit spreads that same month. Okay. Now at point number 4, we roll over. That's great. We're making money on all these call credit spreads, and now at this point I can say, all right, great. I'm going to sell the 11.70, 11.60 put credit spread, and then you're going to go on and sell, you know, sell 2 put spreads here and 6 put spreads here. And a lot of times one of the things that I think people mess up on is when they're doing these index trades is they do iron condors and they put them all on all at once. So, you know, hey, here's price. I'm going to do an iron condor. I'm going to sell up here. I'm going to buy down here. And they got to sit there and take heat on their call side and potentially lose money on it instead of legging in. Okay, so I'm a big fan of legging in. And, you know, you may start off, if you're familiar with iron condors, you may start off with some call spreads and then some put spreads. And it's called unbalanced, meaning that, you know, you're always in the process of either selling one side or the other. You're not necessarily doing them at the same time. It gives you a really big edge, okay? All right, so we got those. Okay, so the other thing is that, and here's a chart of price line, is one of the things that I found, especially if you're a newer trader, is that it's easy to get excited by price action. But if you place these average true range levels on your chart, it will temper your excitement. Here you can see price line went 1, 2, 3 ATR levels. And a lot of times people look at this and go, woohoo, I'm going to buy me some price line. I'm going to buy some calls or whatever it is they want to do. But if you look at this and say, wow, we're at 3 ATRs and we're overbought, you know that there is no way you should be buying this, okay? In fact, you should be preparing for a move back to the mean. So in this case, you can sell a call credit spread on price line, okay? Which is a good rule of thumb. Now, earnings plays can, of course, also wreak havoc on these. And I always avoid, about the week before earnings plays, doing any of this. So here we get to earnings. It wraps up, but typically at some point, it's still going to revert back to the mean, okay? So even those extreme moves. So a few notes on reversion to the mean trading. Yes, it works. First, it is attractive because it has a high percentage win ratio, especially if you scale in as it moves away from the mean. But the start of a new trend, i.e. a fat tail, can kill the system. And this is why it's critical to understand the transition from a reversion to the mean market into a trending market, okay? And I always have this joke, it says, don't be a confirmation whore. And that means you don't want to have so many indicators on your screen that you miss this transition. You don't need a lot of indicators, okay? This knowledge, this transition knowledge, is your most important tool in your trading arsenal. More on this in a bit. Third, the best trades, whether they're RTM or trending, are the ones that are the most uncomfortable to make. I always say write that down and don't forget it, because what happens a lot of times is people want to wait until they feel comfortable to get into a trade, but if you feel comfortable, then it's typically over at that point. It's when you're feeling uncomfortable, wondering if it's going to work or not, typically that's the higher priority entry. All right, so, okay, so we got that. All right, so summing up, oscillators and average true range. Oscillators are for reversion to the mean type trades, and I only fade at ATR levels during an RTM market, i.e. a non-trending market. It's a kind of a choppy market. If it is a new trend market, I will then use the ATR levels as targets, okay? And it's a place to leg out of trades and trail stops, all right? I will avoid selling naked calls and call credit spreads against these levels during squeezes. Why? Because if I have a choice of not getting run over by a potential freight train, I will freely sign up for that choice. So oscillators and reversion to the mean trading work great in markets that are chopping around but get destroyed at the start of a new trend or during a long-lasting trend, all right? So what's an example? What am I talking about here? So here's Apple. Okay, this is a weekly chart of Apple pre-split. And here we had this great reversion to the mean type market, and then the thing just exploded and took off, okay? Here, reversion to the mean trading works great. Here, reversion to the mean trading is awful. You have got to be able to pinpoint and say, wow, this thing has changed. It's changed from a reversion to the mean market into a trending market, okay? And that is where the squeeze comes in handy. What happens is you're going to get a reversion to the mean market when there's no squeeze or when these red dots are setting up, okay? That's a reversion to the mean market. But when you get the first green dot after the series of red dots, in this case with a histogram above 0, that's telling you that there's a start of a new trend. At this point, you want to stop your reversion to the mean strategies and revert to trending strategies, okay? With a trending strategy, I'm never going to fight it. I'm never going to sell a call credit spread on something like this. I'm just going to be selling put spreads, selling puts, and buying pullbacks in the stock if I like the stock. All right, so a very simple rule of thumb there. All right, so the point here is to understand that when you pay attention to overbought and oversold is when to pay attention to overbought, oversold, and when to ignore it. When to fade moves to average true range levels in the expectation of a move back to the mean, and when to completely ignore the strategy and instead use the average true range levels as tools to take profits and manage stops and positions. Okay. So if it's a reversion to the mean market, meaning there's no squeeze, great. You're going to use the to the mean. If it's the start of a new trend, you're going to use the ATRs as targets, trailing stops, and legging into debit spreads. Okay. All right, so we've covered oscillators and we've covered reversion to the mean trading strategy associated with oscillators. The second type of indicator are trend following indicators. Now the most popular of these are moving averages. I like to use the 8, the 21, the 34, the 55, and the 89 period exponential moving averages. I call these EMAs for short. And the reason I like these, they're Fibonacci retracement numbers. They don't necessarily you know, does it matter if you use the 55 period or the 50 period? Not really. I just like them because I do like the Fibonacci sequencing numbers. Sorry, I think I said retracement numbers, but they're a Fibonacci sequence. You know, 8 plus 21 is 34, 21 plus 34 is 55, et cetera, et cetera. Strong trends hold the 8 period moving average on retracements. Medium trends hold the 21. Once it's through the 21, a potential trend change on that time frame is happening. I like to use moving averages and the waves for trend following trades combined with trend lines for entries and prior support for resistance and targets. And I also will use this on all time frames. Are the ATR lines Keltner channels? Yes. So there's a few slides earlier where I showed that you're just taking the Keltner channels and you're creating that. You'll add 3 Keltner channels to your chart, and you're just going to, with a 21 period moving average, and then the first one's going to be 1 ATR, the second one will be 2 ATRs, and then the third one will be 3 ATRs. Okay, so what are the waves? Now, these are an indicator. They're available for a free trial in the App Store in the TradeStation platform. How this works is there's a C wave, a B wave, and an A wave. The C wave measures the long-term trend on whatever market and whatever time frame you're looking at. The B wave measures the medium-term trend on whatever market and whatever time frame you're looking at, and the A wave measures the shorter-term trend on whatever market, whatever time frame you're looking at. If you have a squeeze setting up and the A, B, and C wave are above 0, the odds that this is going to start an uptrend is about 90%. Okay, and that's super valuable information to know. Conversely, if the C wave is below zero, and this is a 39-minute chart, so it doesn't matter. It's all based on the time frame that you're on. You could have a very bearish 39-minute chart, but a super bullish weekly chart. You got to know what time frame are you playing. On this one, this was ExxonMobil. The C wave was below zero. The B wave is below zero. Here's a squeeze. Guess what? We're looking for this to continue going lower, and you can see that the moving average are acting like railroad tracks, walking price down. And this is showing you that this is going to accelerate, okay? When I see this, I'm not going to do reversion to the mean type trades. I'm going to buy puts on options. If you're familiar with options, buy puts here or sell call credit spreads with the idea that the stock is going to continue moving down. So for both reversion to the mean trading and trend trading, you got to realize that the profitable trade, again, is the one that is almost impossible to execute because it seems like, oh my gosh, there's no way this is going to work. It's scary to sell a call credit spread on a stock that's rallying hard. The natural inclination would be, oh, I'm going to buy calls here. But if there isn't a squeeze and it's rallied into the third ATR level, then that's a reversion to the mean opportunity, and you want to understand that. So suck it up and sell that spread. But if there is a squeeze like on BITA, then it actually is okay to do the opposite. You're going to buy calls on strength and sell put credit spreads, okay? And anytime I'll say that, I'll say like, yeah, it's okay to buy new highs. And they'll say, well, isn't that chasing? Well, if you're in a reversion to the mean type market and you're at the third ATR, yeah, that's chasing. But if you're in a trending market, that's a strategy, okay? So here Priceline had its squeeze and burst out. And if you sat there and, first of all, waited for a pullback, you never got filled, okay? And on something like this, it's okay to buy new highs. Like, it can be scary. It's like, man, I'm buying this new high, aren't I chasing? But those are the strongest moves, okay? And they leave people behind. And here's that squeeze setting up. And you can see when you got a squeeze and then you take out the highs, it's okay to quote unquote chase because you've got the power of a fat tail event, okay? And here's Apple on a weekly squeeze. Bam, you've got the power of that fat tail event. And on BITA here, anyone who waited for the pullback on this squeeze, you can see, wow, here's the pullback. Here's the move. I'm going to buy that pullback to that moving average. You missed the entire move. So recognize, it is so important to recognize that transition from a reversion to the mean market to a trending market, all right? And then on a daily chart, you can see that when BITA broke out, it left even the 8-period moving average behind. Now, you were able to buy a pullback here at $77 and catch a little bit of it, but if you were afraid to buy the breakout here with that squeeze, then you ended up missing a lot of the trade. Okay, so on something like this, great opportunity to buy in the money call options or sell at the money to slightly out of the money put credit spreads. So that's the difference between a reversion to the mean market and a trending market with the potential for a fat tail event. And the potential for a fat tail event comes from when a weekly chart has what's called that squeeze on it, okay? So know the difference and don't fight the fat tails. You just dive right in. So chasing, on a side note, chasing is watching the markets move away without us and succumbing to fear of missing a move and placing a market order. Participating in a trend in a premeditated fashion is placing buy and sell stop orders before the new highs or new lows are hit. So hint, use a buy stop limit to get in and buy stop market orders to get out. Okay, well, if you want to get out of something, don't mess around. If you want to get into something, it's okay to be patient. Stop limit orders are for offense, stop market orders are for defense. In trading, to ruin a great track record, you only need to go broke one time. Okay, so I'm going to repeat this again. The profitable trade is the one that is almost impossible to execute. If it feels awful, like a guaranteed loss, that is typically a profitable trade. That's when things are really, really scary, right? With Priceline and the other markets, waiting for the safe pullback means you miss the entire move, and it could be a move that makes your entire trading year. If the trade feels like easy money, then guess what? Human beings all think the same when it comes to greed and fear. Our brains are just hardwired. So if you think it's easy money, then everyone else does too. And if everyone thinks it is easy money, meaning, the joke goes, the confirmation horrors, meaning they've got every indicator in alignment, guess what? Everybody's already in that move, okay? And guess who you're going to buy your position from? You're going to buy it from the people who got in early and they recognize the transition, okay? So that's why you get in when it's tough and it's not so clear, but you've got those clear signals. And then you feed the ducks when they come a quacking, because they will. And what I mean by that is when it's breaking out to new highs, and that's when everybody wants it, that's when you sell off a part of your position, okay? All right, 3 types of technical analysis. We've covered oscillators, we've covered trends, and now we get to the indicator that really matters the most, and that is volatility indicators. Volatility indicators are critical because they tell us when a market is shifting from reversion to the mean trading to trend trading, okay? And this is why a good discretionary trader can beat a mechanical system every time. A mechanical system doesn't know when the market has shifted from reversion to the mean to trending. The trading styles that succeed in reversion to the mean are the polar opposite of the trading styles that succeed in a strong trending market. Note, if your personality is a complete fit for RTM trading, that's fine. Just be able to recognize when you need to stop doing that type of trading and when you can start doing it again. And that's a super valuable piece of advice I learned the hard way, is that I like doing reversion to the mean type trades, but I also recognize that when a market has gone into a trend, I'm going to stop doing reversion to the mean type trades. So volatility is the most misunderstood indicator out there. A lot of times people think it's the VIX, but that's only a really small piece of the story. Volatility indicators include Bollinger Bands, Bollinger Percent B, average true range, ADX, and of course the squeeze. So why do they matter? Low volatility, okay? Low volatility is a period of consensus regarding the fair value of an asset. During periods of low volatility, you get false breakouts and false breakdowns. In those type of environments, if you chase, you die. It's during the low volatility that reversion to the mean trading works the best and trend trading gets chopped to death. So as an example, here's periods of low volatility with low ADX reading, and you can see this market just chops back and forth, chops back and forth, chops back and forth, versus here where it's trending. So typically periods of low ADX readings, i.e. below 20, are great times to do reversion to the mean type trading. Okay, but how do we know when it's about to switch from RTM to trending? Okay, the key here then is the squeeze. So the squeeze, this is a mixture of Bollinger Bands and Keltner channels. You can see here that during the squeeze, you can see that's low volatility. We have a squeeze. We have the ADX under 20, and during this time, it's not doing much. Great time to do reversion to the mean type trades, but when it triggers, okay, you can see at this point, you want to switch to trend trading. Same thing here. Oh, reversion to the mean. We're not doing much, okay? If we get too far down here, we're going to come back to the mean. If we get too far up here, we're going to come back to the mean. But once it triggers, bam, a trend is underway. Okay, that's a very, very, very important shift, and a lot of people don't really understand or realize it, but if you do, that's often the key to turning around your own trading. So the squeeze tells us when a market is shifting from a low ADX reversion to the mean type market into an it's okay to buy new highs and sell new lows type market, okay? You can see here, wow, low ADX, here's a squeeze, great time to do reversion to the mean type trades and price line. But once this green dot signals, in this case the histogram is above 0, it's indicating that it's about to break into an uptrend. At that point you want to stop doing reversion to the mean type trades and switch to trend trades, okay? So here when it rallies you're selling call spreads, and when it falls you're selling put spreads. But here, when it rallies, you're actually buying calls, okay? Or you could also sell puts. But that's all you're doing because you're anticipating a trend to continue. You're not looking for a reversion to the mean. Same thing here. You can see that here's Apple for, gosh, 6 months, traded in a very narrow range. We got a low ADX reading. We have a squeeze. Now the squeeze is telling us that heads up, yes, you can still do reversion to the mean trades, but guess what? The low ADX, of course, you can do those reversion to the mean trades. The squeeze is telling us, by the way, this reversion to the mean type market is coming to an end. Be prepared, okay? That's the heads up for the shift. So the bottom line is assuming that no squeeze is forming or has fired off, then in that type of a situation when volatility is high, i.e. the ADX is over 20, it's safer to take trend following signals, i.e. buying pullbacks and uptrends and selling rallies and downtrends. It is also fine to do reversion to the mean trading. Just be careful you aren't fighting a strong trend. When the volatility is low, i.e. the ADX is under 20, it's safer to take reversion to the mean type signals, which means you're selling highs and you're buying lows, looking for that reversion to the mean. When there is a squeeze, look at it as a sign that a low volatility environment is about to change into a high volatility environment, and be prepared to change your trading strategy, all right? Now, a note on psychology, and I've touched on this a bit, but it's time to dive in and look at the face in the mirror on this. Traders are all wired with the same issues, and this is why most traders take small profits. If all we do is take small profits, then we have nothing to offset the inevitable losses, okay? There is no guarantee in trading. Like if you go fishing, you're not guaranteed to catch a fish. When you place a trade, you're not guaranteed to make money on each and every trade. You've got to know the risk involved. And again, in trading, that which is psychologically natural and comfortable often leads to failure. When a market has rallied to the top of its 3 ATR level, oftentimes people will look at that as confirmation that that stock is good, when in actuality it's ending its run, okay? And that which is unnatural and uncomfortable often leads to success. So thinking about the money as poison. You want to trade the market, not the money. If you get into a trade thinking like, man, I really need to make $1,000 on this trade, your mental psychology is going to be warped, and you're going to go into denial if it doesn't work. And when you go into denial, that's when small losses can turn into big losses, okay? And the market has no idea what a lot of money is. It just knows how to move. It's indifferent to your plight. You might be up 6 ticks and start getting nervous, but the market could care less how you're feeling, because all it wants to do is potentially go up 60 ticks or 600 ticks or more. So the question here is, are you going to take your profits based on what the market is offering you based on its own internal dynamics, or are you going to superimpose an artificial ceiling on your potential as a trader based on an irrational internal psychological bias regarding how much money over what period of time is too much or too fast? And it's your choice. And I would just like to say that and just kind of remember that and keep that in mind the next time you're placing a trade. All right, so that's what I have. My contact info is here. This is our offices right here. This used to be a grocery store, and we had it gutted and refurbished, and this is where we work now. A great team of folks. We're sitting there trading options and doing things like that. I'm in Austin, Texas. You can email me, support@simpleroptions.com. And if you are interested in options, we've got a lot of great free information on our site, which is simpleroptions.com, as well as specific picks, alerts, and different things like that. And always remember that our premium indicators that we've built for TradeStation can be accessed in the TradeStation App Store and given a free trial to see if it's something that would actually fit into your own trading strategies, okay? Mark, does this work for futures contracts? Absolutely. I do the same concept with futures as well. If you look at a monthly chart of crude oil, you'll see that that big squeeze on there, which crude oil has been in a reversion to the mean type market for years, and that big squeeze on there triggered to the downside. So I still think we actually have more downside on crude oil based on that chart. I have your squeeze for radar. It's several years old. No, Mark, that's fine. That's actually the same one I'm using. Yeah, there's no, it's a pretty simple indicator. All right. All right, guys, that's what I have. If you have any additional questions, I'm happy to answer them. Otherwise, that's kind of my try to compact everything I've learned in trading over 25 years into a simple presentation, and this is what it boils down to. And whether you trade outright stocks or ETFs or futures or currencies or Forex, or you actually like trading options on those instruments, you can use everything here that I showed you today. All right, guys. Well, have a fantastic rest of the day. This shouldn't be a boring trading week. And oh, how do you set that up when the Keltner channels? So there's a slide near the beginning of the presentation. All you're going to do is go into TradeStation and insert the Keltner channel 3 times, okay? And then you're just going to change the average true range level on each one. So you're going to have it as, the first one you're going to have it as 1 ATR, the second one is 2 ATR, and the third one is 3 ATR. And then what I like to do is I just change the colors so that the 3 ATR is red, so both the upper band and lower band are red, etc. So that way the colors are the same. You do covered calls. With this, especially in reversion to the mean type market, covered calls is great. So if you own a stock like IBM and it gets up to that 3 ATR level, great place to sell covered calls against it. All right? Oh, there we go. That's the slide right there. Thank you, Stan. It's like I can explain it for you, but a picture actually is easier. What are the pictures of the hall? Oh, that's our office. That's the before and after of our office. Stan's going to come to Austin on the 24th, so I'm going to try to get him up here. And Stan, I'm not sure if you're a fan of elk or not. We got a great restaurant that serves wild game up here near the office. Actually, I think we ate there maybe the last time you were up here a long, long time ago.
I do remember where we had dinner. It was a lovely place, and is it fair to say that I'm game?
I think you are. You're game.
Game for elk. Okay. We always hunted elk quite a lot in Brooklyn, but that was different.
Nice.
John, I want to thank you for the presentation today and thank everyone for sticking around with us. If there are any other questions, type them in or hit John at his email. I'm going to go back to that slide if I can to put up John's contact information. Let's see. There we go. And I want to thank him for the presentation. Actually, that was it was really very an important. It's something we often look past is identifying the characteristic of the market, and we often look past those basics and we get indicator crazy, or I won't use the words you use, John, but we get a little carried away with indicators. So my thanks to John, my thanks to everyone for attending. I will leave this open for a few more minutes in case you need anything from the documents area or John's contact info. And other than that, I think we're closed. If you want to, John, if you want to mention what Jim is asking about FOMC meetings, you can go ahead and do that. Otherwise, we'll close out.
Oh, sure, sure. Yeah, no, Jim, I actually like to look at those FOMC meetings. I'll just look at a daily chart with those average true range settings, and oftentimes, you know, when you see those FOMC meetings, and you know, you have this kind of a spike move and it peters out, it's typically right at those 3 ATR levels. So that daily chart, if you're looking at like the spiders or even the S&P futures with those 3 ATR levels, yeah, I very much like that during FOMC meetings. Yep. Okay. Good deal.
Excellent. Thank you very much, John. Thank you, everyone, for joining us. Trish, I would suggest sending an email to John if you want to find out more about the slides. And I'm sure he can make some of the information available to you that way. So I would contact him directly. Thank you, everyone. This will go up into our archives, as I mentioned before. Have a great day. My thanks again to John. I look forward to seeing. And if you're in the Austin area, by the way, we're doing on January 24th, we're going to be doing a presentation. I'll be speaking and John will be speaking. And if you need information on that, you can email me at TS Labs. But that will be in Austin, and that's what's prompting my trip. And if you're in that area, want to come by, that would be great. Have a good day, everybody. Thanks again to John.
Yep. Thank you, Stan. Have a good night.